Jim, I'll just let you kick it off with an explanation. What is home equity investing for folks to whom it's a new concept?
Sure. Home equity investing, it's also known as home equity agreements. We use HEA, some people use HEI, but essentially what it is bringing equity finance to residential real estate. So if a homeowner wants to tap into their equity, they traditionally would do something like a HELOC or refinance their mortgage loan. These are debt-based products where you borrow money, you owe the money to the lender, and you pay interest, and you make monthly payments. Our product provides a lump sum of cash without interest, without monthly payments, and in return for providing the money, we're going to share a portion of the home's value when the homeowner decides to sell or buy us out. So it's true equity finance. It's very fundamental. It's like the difference between stocks and bonds, for example. Corporations can issue bonds if they want to raise money, or they can sell stock if they want to raise money. This is the same kind of concept where the equity product, which was never available to residential homeowners, now has become available.
Okay, so you mentioned the no monthly payments, which I guess would be attractive to some borrowers, but why would somebody come to you as opposed to just going to their bank or a lender and getting a HELOC or a home equity loan?
Sure. Well, there's a couple reasons. First of all, let's talk about people that can't get a loan. Surprisingly, there are tens of millions of homeowners in the United States that have lots of equity in their home that actually have no access to a mortgage loan. They might have unusual type of income. Maybe they're gig workers, self-employed, whatever. Or they're older and they're retired. They don't have a steady stream of income to support a loan, and get through the underwriting process. Or they're just struggling families. So by our estimation, there's some $3+ trillion with a T of home equity that's locked up in homes owned by homeowners that don't have access to a mortgage loan. So for those folks, we hence the name Unlock for my company. We unlock that equity for them because we accept credit scores as low as 500, and we don't do an income underwriting because we're not trying to determine that the homeowner has the means to make monthly payments. That's the benefit of an equity investment product. There's no debt service, right? So the first thing is that there's a whole group of homeowners that we give access to their equity where they didn't have it before. Then there's other homeowners that do have access to a home loan, and you're saying, like, why would those folks do it? We actually have, you might think, well, none of those guys would do this, right? But actually we have lots of them. There's a lot of value in being able to obtain the financing you need without having to service the debt. So it's like, do I really need another monthly payment? I want to maybe remodel my home, and I can get the money now from someone like Unlock and not have to make monthly payments. That's attractive to people. Not everybody, and the product's certainly not for everybody, but there is a lot of value for people in doing that. And sometimes people use the money to start or fund a business. And when you're building a business, you certainly, the cash flow is really important to you. So the last thing you might need is another monthly payment. So there's a lot of utility in the product. It just depends on the homeowner's specific circumstances.
And so walk me through a typical deal. How much is one of your customers, your clients, typically taking out? How much are you investing in their home?
So the typical profile of a homeowner is somebody that's in their 50s, typically lower mid 50s. They've been in their home for maybe 8 to 10 years already. They have lots of equity in the home. They have our average FICO score is actually we use Vantage, but our average credit score is in the low 600s, like around 630-ish, 635. The average home value is around $650,000 because we're doing a lot of California properties. That's where we started, and that tends to drive the average up. Although we're in 20 states now, so the average is falling over time as we've expanded our geo footprint. And then the average size of the investment that we make in the property, which is the same thing as saying the average cash that the homeowner receives from us, is about $95,000.
Okay, $95,000, so just under $100,000. And I've heard you say this in years past, but so my stereotype of homeowners, and probably most of the reporters in this room have the image of American homeowners as having very high credit scores, very solid financial pictures. What's going on there? How do these folks have 600,000 in home equity and 600 credit scores?
Well, look, there's a lot of people that, well, first of all, our customers are all homeowners, right? So that means that the vast majority of them bought their homes. Some of them might have inherited the homes, but most of them bought their home, which means that when they bought the home, they were able to qualify for a home loan, because very few people buy a home for cash, right? So these folks did have the ability to qualify for a loan. But what happened to them was life happened to them, right? I mean, life throws all sorts of curveballs at people, and people wind up getting into, financial distress or for whatever reason it might be. It's usually something related to a job loss or a medical problem with a family member. It might be a divorce. It might be a death in the family. So things happen to people that put them into situations that are challenging for them. And there's all kinds of research reports out there that show that sort of like people sometimes don't like to think about this, but there are tens of millions of families that are having a rough go at things. And they're homeowners. A lot of them are homeowners. Another thing about these folks is that when mortgage rates were low, a lot of these folks were the cohort that was unable to refinance their mortgage and take advantage of low rates because they didn't qualify for a loan at that time. So a lot of times we see these folks, they have higher interest rates on their mortgage loans because they weren't able to get those 3% loans when they were available. And when your credit is damaged, it's painful. It unfortunately costs a lot to be in distress. You wind up paying for more. You pay more for things, and it kind of puts you more in distress. And once you get it, a lot of folks get into what we call the debt trap. They try to borrow the way out of it. They've got high interest rate credit cards, and they get overwhelmed on the payments. And a product like ours is the ability for a homeowner to basically reset. Right? They can pay off all those expensive credit cards, eliminate those monthly payments. We don't report to the credit bureaus because we're not a loan. So the difference between us and, let's say, a debt consolidation loan, if the homeowner can even get a debt consolidation loan, with a loan, they are replacing expensive credit card debt with a lesser expensive loan. But the amount of money they have borrowed, i.e. their credit utilization, is the same. Okay, and they still have to make monthly payments on that new debt consolidation loan. Okay, so they're still kind of having a hard time with that perhaps. With our product, the payment, the credit card debt or whatever high interest rate debt they're paying off, that's gone. It's eliminated without borrowing. So there's no loan taking its place. So your utilization goes way down, right? And that's what the credit bureaus see. All of a sudden there's a bunch of debt gone and no debt replaced it, okay? And since we don't have a monthly payment, it becomes easier for the homeowner to manage the remaining obligations that they have. So they're more likely to pay on time. The combination of being more likely to pay on time and eliminating debt and lowering your utilization puts the homeowner in a position where if they behave properly and good financial habits, their credit score can recover quickly. So this, again, it gives people a chance to kind of get their feet back under them and get past the problem that they have.
Well, and that's a big if they behave properly. Are you coaching them up on how not to get back into trouble?
Well, we do. Sometimes we require them to pay off debts as part of the underwriting in order to qualify. I mean, we don't put stipulations on what they can do with the money. We want them to do that, and we're thinking about implementing counseling, like we're making counseling mandatory for this. It's probably something that we will do at some point. But the homeowner, a lot of people enter into the agreement, and they tell us up front, I'm going to use your money for a couple of years. I'm going to pay you guys off in a few years. And we give them 10 years to end the contract. But I'm going to use this for just a couple of years. I want to pay off these debts, get my credit sorted out, and buy you guys out. So a lot of people are entering this, with the intention of improving their circumstances.
Okay.
Yeah.
And so just to be clear, this is not cheap money, like compared to a 7% mortgage or a 9% HELOC. How much are your clients typically paying for this investment?
So it's one of these questions where you have to answer it with, it depends. Okay? there's only one payment the homeowner makes to us, right? It's at the end of the contract. We give them 10 years to pay that. The longer the homeowner holds our money before paying us, the lower the cost is on a percentage basis, but the larger the dollar amount is, assuming their home value is going up, because we get a percentage of the home value, right? So, but let me give you an example. If the home value rises by, let's say, 4% a year, okay, which is kind of like pretty close to the national average, somewhere between 4 and 5% a year. If it goes up 4% a year and the homeowner takes our money and pays us 10 years later at the end of the term, the money's going to wind up costing them about 10 or 11% per year over that entire time period. That's the way the math works out. It's actually, for a lot of our homeowners, that 10 or 11% is less than the HELOC rate that they would get if they got a HELOC, because they're not prime credit. The HELOC rates that you mentioned, 8-9%, those are for people that have good credit.
Right.
There are a lot of people that are paying 12, 13, 14% for HELOCs, and a lot of our customers would be in that bucket. So our money's actually cheaper if they hold it for the 10-year period. If they end it sooner, they're going to pay us less dollars. But when you run the math to see what that annualized return was, it's higher. But we are capped. Our product is capped. So the homeowner can never pay more than 19.9% per year. And if they end the contract in the early years, they're going to wind up under the cap, most likely they're going to pay that. But if you're using our money to pay off credit card debt or personal loans that have 25, 27, 30, 35% interest rates, and our money can't ever cost more than 19.9, that's still, pretty useful trade.
Right, okay. And so let me ask you about the broader industry. So you're one of 4 big players in home equity investing. And so, fact check me on this, the others are HomeTap, which is affiliated with Fortress Investment Group, the big private equity player. Unison has an investment from Carlyle, the big private equity group.
I used to be the co-CEO of Unison.
Okay. And then who, I'm sorry, I'm blanking on the fourth player.
Point,
okay.
Yeah.
So there are 4 of you. I guess just give me a sense of the volumes. It seems like still a niche product, but what's the volume and why the interest from private equity?
Well, it's growing quickly. For many years, the product was relatively unknown to homeowners. It was relatively unknown to investors. And when you have a new product like this, you have to basically evangelize, and you have to kind of, blaze a trail, if you will. It takes time to get the large, investors, ecosystem, ready to sort of engage with a product like this. So we spent the last 3-4 years, I spent a lot of my time making presentations to investors, explaining how the product works, answering questions, helping them get through their investment committee process where they can get the approval to invest in these types of assets. And we got rating agencies to rate this product. So now we're able to, using warehouse financing, we've got warehouse financing from companies like Barclays and Texas Capital Bank and Nomura and others that got a couple brand new ones coming in. So some of the very largest warehouse providers are now willing to provide warehouse financing. So the originators are originating contracts, selling them to flow buyers. The flow buyers are using warehouse financing to do that. This is kind of similar to how other asset-backed things are originating. Right? People are using warehouse financing. So the flow buyers are aggregating the contracts. When they've got several thousand of them, they're able to contribute them into a trust and securitize them and sell bonds to large Wall Street investors. Much the same way that you'll see auto loans and credit card receivables and non-performing loans and HELOCs and all these other types of asset-backed securities being issued. We've accomplished all that in the past few years. So at this point, it's kind of like the investment community is kind of open for business. Now that there's more capital available, and the capital's getting cheaper, which means we're able to lower the price to the homeowner as well. Right? We recently lowered our price to the homeowner. That's what we're always trying to do. It's a flywheel. The cheaper the capital, the more people are interested. The more deals we do, the more the capital gets interested. There's plenty of volume, I believe, available for this because, as I mentioned, there are tens of millions of households that don't qualify for a loan, And there are many millions of others that would rather not service the debt to tap into their equity. So we think the product can get a lot larger than it is now. Ultimately, we don't know how big it can get, because we haven't gotten there yet. But it is growing, and in terms of how big it is to date, we've done approximately 14,000 units ourselves. The other players in the space that you mentioned are all, in that same neighborhood. So between the largest players together in aggregate, we might be somewhere near 60,000 units. But I'm talking not in 1 year. This is lifetime.
Okay.
So it is still relatively small.
Yeah.
You look at, there are millions of mortgage loans.
Yeah, probably tons of them.
But I think it can get quite a bit bigger.
Okay, interesting. And there have been a couple of developments in your niche since you spoke last year. One is that the Massachusetts Attorney General sued HomeTap, saying that the customers weren't properly explained, disclosed all of the details of these investments. What's going on there?
Look, some regulators look at the product, and when you're a mortgage regulator, you know the old saying, when you've got a hammer, everything looks like a nail, right? So a lot of times regulators, their first instinct when they see this product is, well, it's not maybe a traditional loan, but it kind of looks a little bit like a loan. I mean, you're giving somebody money, and they do have to give you a payment in the future. It's sort of like a loan, but we obviously don't think it's a loan at all. It's the difference between stocks and bonds. It's that fundamentally different. But if you're a regulator, you might say, well, I want to regulate this under a mortgage loan, so I'm going to tell you that this is a loan product, and you should be licensed. So this is sometimes the regulators' stance that they take. We as the industry disagree with that. We think that and by the way, let me make this statement: the industry, and I can speak for the others in the industry as well, because we've got a coalition that we've formed called the Coalition for Home Equity Partnership. And the three founding members are HomeTap, Point, and my firm Unlock. And we're bringing others in. But we want to be regulated, to be clear. No one in this industry is trying to avoid regulation. We're trying to build long-term businesses here. And the way to do that is to treat homeowners fairly, put in proper guardrails, all those things that you have under mortgage regulations. So if you think about what do mortgage regulations provide? They provide, I like to call it the 5 pillars of regulation: licensing requirements, reporting requirements, caps on costs and fees, standardized disclosures, and prohibited practices. Those are the 5 things that you get from mortgage regulations. We want the same 5 things in our industry, but we want the regulations to be written so that we can physically comply with them with our product. For example, if you tell me that my product is a mortgage loan, well then I'm required under mortgage law to disclose an APR. But I don't have an APR to disclose because I don't have an interest rate, I'm not a loan. So I can't actually comply with the mortgage regulation. And there's lots of other examples of that. I'm giving you one example. There's a dozen places where, maybe more, depending on which state you're in, where we can't comply with the regulations. So it's unfortunate that some regulators say, oh, let's just call this a loan and we'll kind of figure it out. But that's kind of what's going on in Massachusetts. Not everybody agrees in Massachusetts that the product is a loan. That's the position that the Attorney General is taking. That's going to play itself out. We'll see how it goes. But yeah, in the meantime, we are engaging directly with state regulators and proposing legislation that would create a new sleeve of regulation that would put us under the jurisdiction of the same regulators that regulate mortgage loans, but would be something that we could physically comply with.
Well, I think almost by definition you're going to have some unhappy customers. I mean, this is a complicated product. It's new. It's probably hard for some people to understand. You're focusing on clients who are in some degree of distress. From the standpoint of a homeowner who comes to you, like what should they be thinking about as they go into this arrangement?
Well, look, we want our homeowners to understand how the product works, and we take great pains to do that. I'll speak specifically for Unlock now, but I think it's a fair statement to say that my competitors do something similar. We model our disclosures after the mortgage disclosures, simply because it's a format that people are familiar with. So with mortgage, you have the TRID requirements, and you have something that they call the loan estimate, and then you have another one that's called the closing statement. Well, we use the investment estimate, and the investment closing statement. And we provide the similar type of disclosure. We provide the estimate first, which is kind of like a term sheet. This is the deal that you're going to get. And we actually conduct a mandatory phone call with the homeowner to walk them through that. We don't just give it to them and assume that they read it and understand it. We walk them through it. Want to make sure if you have any questions about any of this, this is what your deal is going to look like. This is how you're going to pay us in the future. These are the range of payments that you're going to get. And we give them tools that enable them to determine how much this might cost. And we can't actually tell them up front how much it's going to cost, because we can't predict their home's value in the future. We can't predict how many years they're going to hold the money before they settle with us. But what we do is we give them what amounts to like a matrix, right? And so we have a 10-year product. Our matrix has 10 columns in it, one column for each year, and it has rows in it, and each row translates to a different future home price scenario. So the homeowner can say, I think my home's going to go up 3% a year. Okay, that's that row. And I think I'm going to stay in this for 8 years. Okay, that's that column. And I look for the intersecting point. Okay, that's how much it's going to cost me. So we give the homeowner a way to, in their own mind, imagine different scenarios and see the impact. And we think that's the clearest possible way to disclose. And by the way, I'll take the opportunity to say this: loans provide an APR. APRs are actually incorrect. The APR is an accurate measure of cost only if the loan goes all the way to the end of its term. If the loan is paid off before the end of the term, the APR is actually understating the cost of the loan. That's just how it works. We don't do that. We show everybody the full spectrum of the 10 years. We show the costs along the way. So our disclosures are actually far more robust than what you get with a loan. Now with a loan, people don't really care. What's my rate? That's what they care about, right? But this is a little different, so we go the extra mile. And like I said, we walk the homeowners through, how this works. We do the best we can to provide, a quality education for them and good disclosures. And that's all we can do. At some point, we may require counseling, so that's coming. And you did make a comment that the product is complicated. I mean, look, any financial product is complicated. The average homeowner, I think, would have no idea how to calculate an amortization table for their loan. That's pretty complicated. But they don't know how to do it. They don't know how to, think about, annuities or things like that they might get. They don't know how to analyze the stock that they buy. They don't look at the company's earnings and do a cash flow model to figure out if that's a good stock or not. They buy the stock and hope it goes up. So, I'm not saying that, homeowners are unable to learn about how these things. At the end of the day, our product it's actually, you can boil it down to something pretty simple. If I give you a certain amount of money, when your home sells in the future, or you want to buy us out, you're just going to give us a percentage of the value of the home. That's really quite simple. Here's a pile of money, and let's say our percentage is 20%. We're just making up a sample deal. I'm going to give you this much money. In the future, you're going to owe me an amount equal to 20% of your home value. Most people can understand that. And there's a cap. So if it ends early and my return on investment exceeds 20%, I'm going to be capped at 19.9%, right? So people can understand that. It's not terribly difficult. There are some, additional nuances and things like that.
Well, and the other new development since you spoke last year was that one of your competitors started offering traditional home equity loans. Is that going to be a trend in the industry?
Which one?
Oh, I think it was Unison in Nevada.
So Unison is not, what they offer is a hybrid actually.
Okay.
It's kind of like a HELOC that has an equity component to it. So if you imagine a HELOC, let's say the HELOC would have, and I'm making up numbers here, let's say the HELOC would have a 10% interest rate. They would say, okay, I'm going to give you the HELOC for 7% interest rate, and because I'm giving you a discount on the cost, you're going to share some type of equity in the future to kind of compensate me for giving you the lower rate. It works like that.
Okay.
Yeah.
Now, so is that something you're looking at, or is that something that's going to become more common?
We looked at that, of course. We look at all kinds of different product structures. We like the simplicity of what we do now, because that gets a little bit more complex,
right,
because you've got a loan and an equity thing bundled into one investment. So right now, our customers seem content in doing the equity agreements, and so that's where we're focused.
Okay.
Yeah.
And now back to something you mentioned earlier. So your contracts go for 10 years. So if I don't sell my house within 10 years, what happens?
So at the end of 10 years, our agreement comes due, if you will, and you can pay us off. If you have cash available, you can simply just pay us an amount that we would get if you sold your home, the same amount, or you can refinance your home to raise the money. You might be able to maybe borrow against the home to raise the money to pay us, or you could do another one of our agreements to raise the money. So essentially, like, get a new 10-year deal from us, use the money from that to pay off the first one, and now you have another 10-year deal, and you still don't have monthly payments. So those are some of the choices that people would have at the end of the 10-year period.
Have you ever had a default?
There's been a very small number of them. We have not had a default on our contract. It's if you think about it, we don't have monthly payments to collect,
Right.
so there's nothing to default on there. A default typically means that the homeowner is in default either on their property taxes or on their mortgage loan. Because in most cases, we're in second lien position, right? There's already an existing loan on the property. So if they get into trouble with the mortgage lender, that's a default under our agreement, but they're really a default under the lenders.
Okay. Well, yeah, let me rephrase. Have you ever not gotten paid back by a borrower?
We've had a couple of situations where, there's been a default on the loan, and the homeowner, winds up underwater on the loan. Home value may have gone down. Maybe the appraised value wasn't accurate up front. We've had some losses, not many. And we haven't, to be fair, we haven't gotten to the end of the 10-year term because we started originating only, 4 years ago. So we still got a way to run before we get to the end of the term.
And so what's the major risk to you? I mean, I guess if home prices go down, you could potentially lose money on some of these deals, but what's the worst case scenario for you?
A lot of things can go wrong in a 10-year period. We don't have, loans have amortizing balances, so you put your money at risk by lending it to someone, and you're getting little bits of it back every month, which reduces your risk over time. You have less of your principal outstanding, you're getting paid along the way. We don't have any of that. Our investors put the money at risk, and then we don't get paid for up to 10 years later. So it's it's a different risk profile. If the home value goes down, if the homeowner doesn't pay the mortgage loan, and then the lender starts tacking on penalties and unpaid interest, and the loan balance is now growing instead of shrinking, you can get a situation where there's not enough proceeds from a home sale, especially a distressed home sale in foreclosure. If the lender's foreclosing, we might be wiped out. There might be nothing left to pay us anything, even though we have a lien on the property. And importantly, we are a non-recourse product. Loans have recourse to the homeowner. So if a lender doesn't get paid in foreclosure, the lender can actually go to the homeowner and try to attach to the homeowner to recover a deficiency under the law. We can't do that. Our contract is specifically non-recourse. So if there's not enough proceeds to pay us in a foreclosure situation, we're out of luck.
Okay. All right, well, we're at 9:20, so that means Ralph is going to start making motions and faces at me, so we got to wrap it up. I didn't mention another important thing, which is that your father turned 99 yesterday.
Woo! Father did turn 99, yes.
All right, well, thanks a lot, Jim, appreciate it, and thanks, everybody.
Thank you all.